So here in this video, I'm going to explain something you critically need to know before tomorrow morning. This has to do with the CPI report that will come out at 8:30 in the morning tomorrow. There's also a growing risk that we could see an Iranian attack on Israel potentially tonight. One big red flag of that, if you will, came out today. Markets did not pay too much attention, but I do think it's something worth highlighting. And it's funny because you notice today in regards to the PPI data that came out, in fact, stocks rallied on that, but you had a lot of people on Wall Street start to turn their attention towards a recession today. Yes, there actually was a lot of talk about a recession on financial media in a day in which the S&P went up 1.6%. So why is that and what's going on? And then finally, it was a great day for Tesla today. Tesla was up over 5%. What is coming next? After all, I've forecasted this today, so maybe I can provide some perspective for you that makes things a little easier to understand. And we should start there. I expected a good day today for Tesla. Now, not only because PPI I thought would come in lower than expected, but also yesterday Tesla underperformed the markets because of some anticipatory selling heading into the Elon Trump interview or conversation, whatever you want to call it, on X. Some people were a little nervous that maybe Trump and Elon are not as buddy-buddy or friendly as we think, and maybe it's not, after all, a positive for Tesla in the end. That was really a, sell the rumor, buy the news situation. And I think that's why Tesla did so well today and really outperformed the markets. Now, you also had PPI that came in lower than expected, and that was expected from me, at least. I expected PPI was going to come in really low, and this would cause Tesla stock to break out. That's in fact what happened. You broke out above the 200-day moving average, as I expected, and a retest of the 50-day moving average could be coming soon. That is around $211.52 per share. And if things do go well this week, I could see Tesla stock being as high as $215 by Friday. But there were some concerns by analysts and money managers today, especially on financial media like CNBC, Yahoo Finance, Bloomberg, Fox Business, about a potential recession because of your data that came in this morning. PPI came in lower than expected and basically across the board shows a deceleration in inflation from producers. A very important concept to understand is PPI is producer price index or producer price inflation. Producer prices not going up as much as expected is great. Okay, that's good for margins. That's great all around. But with the kind of drop that you've seen today with PPI, if that leads into CPI and you see a drop in CPI as well coming tomorrow or over the next coming months, perhaps into deflation territory, that's not good. That is a sign the economy is slowing down. And PPI coming in so low today is also a sign that the economy is slowing down. Liz Young-Thomas, she is the head of investment strategy at SoFi, puts it well. She says the PPI trade services month-over-month print was the second lowest on record. This attempts to measure wholesale and retail margins, suggesting a meaningful decline in profits. More of this would not bode well for earnings in coming quarters. And you do see this kind of correlate to boom times in markets like 2021 and the first half of 2022, where profits were really good, and then the second half of 2022 and 2023 where you did go through a bit of an earnings recession that did correlate with a lot more of these red downward shoots, if you will. And this was a big drop compared to last month's big rise. So in fact, the bottom line is PPI and CPI coming in low or lower than expected, perhaps soon to be in deflation territory, is actually really bad for company margins, profitability, and it's a really bad sign for the state of the economy. Did you know if you don't, you're about to. 97% of CPI reports are positive, meaning 97% of inflation reports show prices going higher. Only 3% show prices actually falling. And the only time you've seen prices fall is during recessionary periods. And like 3% of your CPI reports that are indeed deflationary, again, they've only ever happened during recessionary periods. So deflation does not go well with economic growth. In fact, honestly, you can forget about the SOM rule, forget about the inverted yield curve, forget about everything else. When you get that first deflation print for CPI, that's really when you want to start questioning, are we in a recession already? Are we going into a recession? Nick Timmerhaus posted the forecast from your major banks around CPI. And good news is you're not expecting a deflationary CPI report coming tomorrow morning. You're expecting a median CPI of 0.19%. So that is the average of all of these banks put together. But due to last month's surprisingly low CPI, I mean, you were almost in deflation at 0.06%. It does have the estimates all over the place. So the lowest estimate is 0.08%, just barely higher than last month's. The highest estimate, and that's from Nomura Bank. The highest estimate is from Bank of America, and that's 0.22%. So there is a wide range of expectations for tomorrow's CPI report. And in fact, the best case scenario could actually be CPI coming in around expectations or slightly lower, maybe 0.15%, perhaps as low as 0.10%. But I think the paradigm has really changed in markets from last month's, CPI report came in 0.06%. There wasn't really concerns about growth on any kind of material scale at that point. So that really low CPI report was seen as, wow, this is just great news. Now that investors are concerned about economic activity, if we were to get another report that is that low, then I think Wall Street's going to start asking the question, is this a sign that the economy is really slowing down? Because consider for a moment, last month's CPI report, if that was annualized on a 12-month basis, that would bring you in at 0.72% year-over-year CPI in 12 months. That would not be a good environment for stocks. That would not be I should say it like this. That would not be a good environment likely for the economy. If you really weren't seeing much inflation, that's probably not a good thing. And I know this sounds crazy, like not enough inflation. Wow, that's ridiculous. Inflation normally revolves around the business cycle. When you see high inflation, normally the economy is doing well, okay? When you see low inflation or too low inflation, the economy is doing so-so normally. Now, we have went through this 10, 20-year period of really low inflation ever since really the global financial crisis. We've had a problem of too low inflation, but that low, like that would be lower than our, prior 10, 20-year historically low period of inflation, right? That allowed us to keep interest rates low for a long time, since 2008. That would be just way too low. And super low inflation would also pressure companies' margins. And I think that's really the bottom line if you're an equity investor. Whether or not the economy is doing so-so, doing okay, doing a little bad, or a little good, really doesn't matter. Company margins would be under pressure if they were not able to raise prices at all, right? If you think 2% inflation is the target and companies on average can raise prices 2% a year, let's call it, and now they can only raise prices, marginally, if not any, because let's be honest, if CPI is coming in like that, it's going to be concentrated most likely in services, and goods are probably going to be in way deflation territory, right? So a lot of companies will not even be able to raise prices. The economy, the consumer will not stand for it and start to not buy the product as much. And that's going to be bad for margins. So in inflationary periods, margins tend to improve. During deflationary periods, margins tend to fall. And that's what is so important about tomorrow's report. You actually don't want a really, really low number tomorrow, because that could spark more concerns about the economy, about corporate profitability, and ultimately margins over the coming months. Best case scenario is probably like a 0.15% month over month number, and times that by 12, you're looking at 1.8% inflation on an annualized 12-month basis. So that would be, a perfectly fine number. At 0.19%, if we're spot on with consensus, that would be a 2.28% annualized CPI number. That would also be just fine. Now, here's where things also get weird, because if you come in slightly hotter than expected, that may not actually be a terrible thing from the market's perspective as well. With PPI that just came in super low today, if CPI comes in higher, that means companies are actually able to pass on costs. That would mean the economy is likely doing better than we think, and that would be good for corporate profitability. Now, you don't want too high. Anything higher than like 0.25% might be seen as bad news. That would be 3% on a 12-month annualized basis. That would really be the average over the last almost 12 months. Technically, it's at 3.2%. Or 3.3%. So it would still be lower than the 12-month average. It would still help push us down on a year-over-year basis. But a little bit of inflation here would not be a bad sign for the growth scarers out there. The people that think that growth is starting to fall off a cliff, or the consumer is rolling out of bed, whatever terminology you want to use. So in fact, the more worst case scenario would be a number like we got last month, like 0.06%, because pretty soon with those kind of numbers, you're going to be in deflation, and then you're going to have an economic problem at that point. Now, for the growth scarers out there today, Nick Timmerhouse posted this on his X account. Home Depot cut its outlook for sales amid signs that tight interest rate policy is slowing demand. It says, quote, categories like kitchen, bath, lighting, flooring, all these categories that are components of larger projects have seen the greatest degree of softness. Even Ryan Dietrich, that has been one of the more bullish fund managers on markets, he says, let's repeat, inflation is last year's problem. We've been saying this all year, meaning this year's problem could be the economy. That's why it is so important the Fed recognizes this and starts to cut. And for the bulls out there, the buyback blackout period is officially over with en masse. Goldman Sachs says here, August to September buyback season is the second best of the year. The window for buybacks has now reopened with an estimated $1.15 trillion worth of authorizations. That's trillions with a T. Keep in mind, buybacks are authorization, not obligation. So if companies do not want to buy back their stocks, they do not have to. But if they want to, there's definitely a lot of money that can be allocated to it. Peter Berskin on X says, nice pop in the NFIB survey this morning. Came out about 5 o'clock this morning. It says the level is now consistent with a mere recession rather than a full-blown depression. Meanwhile, economic uncertainty is at a post-pandemic high, and a net 16% of respondents said sales declined over the past 3 months, and 4 points worse than in June. Great. And while there is a lot of mixed data on this, consumer strength, like that, those two words, as far as transcript mentions, did pop in this latest quarter. So consumer strength could be getting better, but there can be other contexts there that got flagged. Like, for an example, a company might say consumer strength has been weakening, but that would still get picked up as consumer strength. So kind of want to take some of this with a grain of salt, but there could be a better trend of, forecasting the consumer ahead. I think that's going to be the main focus point for this week after retail sales. Retail sales, we're going to get a lot more updates on the state of the economy, how people are spending their money. That's going to be Thursday, 8:30 in the morning. And around the same time, you're also going to get Walmart earnings, and Walmart is like the bellwether of the consumer. Okay, now Walmart has had bad things to say about the consumer for a while now, that people are not buying that premium brand. They're switching down to more generic or store brands. People are not buying discretionary items, but overall, Walmart has had decent things to say about the consumer. In fact, in 2007, during the summertime, before the shit ever hit the fan, Walmart was one of the first companies. I shouldn't say one of the first companies, but one of the main companies that warned about the consumer, that started to get people's attention. Now, Walmart was saying some, pretty dire things at that time, that they did not think the consumer was going to get better in coming quarters. And, it's like some of Wall Street paid attention, some of Wall Street did not. I think this time around, all of Wall Street's going to be paying attention to exactly what Walmart says. If they have anything bad to say about the consumer, their earnings come in bad, anything along those lines, that's going to be a little bit more of that growth scare coming back into markets, especially if retail sales do come in bad at the same time. Fundstrat with Tom Lee and Fundstrat are reporting that of the 456 companies that have reported so far, 91% of the S&P 500, overall 79% are beating estimates, and those that beat are beating by a median of 6%. Of the 20% missing, those are missing by a median of 5%. On the top line, overall results are beating estimates by a median of 6% and missing by a median of 5%, and 58% of those reporting are beating estimates. So only 58% of companies reporting earnings are actually beating. That's not a great number. And Bank of America posted this chart that says 76% of fund managers say a soft landing is coming, 13% say hard landing, and 8% say no landing. So back during April, for an example, 36% of fund managers said no landing, 54% said soft landing, and 7% said hard landing. You jumped up to 11% for hard landing the next month, dropped to 5% the next month, back up to 11%. Now you're up to 13%, which is the highest you have been at since January of 2024, when you were at 17% of fund managers expecting a hard landing. So, I look at this, and even though you've had growth concerns, the S&P sold off 10% top to bottom of this correction, if you will, if that's what we want to call it, the odds of a recession still really have not went up. Okay, you're still sitting lower than any other point you were at in 2022 or 2023. If you do start to get more definitive recession concerns or growth concerns coming out, you could see material downsides still in markets. I mean, earnings estimates for 2025 have not moved. They're still sitting at the highest point we've seen in 12 months. If you start to get some of those growth concerns and margin concerns, then those earnings estimates for 2025 are going to come down, and that's where you get the fundamental pain for markets. Beyond just geopolitical tensions that are not going to have any effect on S&P earnings, whether or not we get a larger slowdown, that's really not going to have an effect on S&P earnings until it happens, right? But when you actually start to see the estimates come down because of a potential growth scare, that's when the numbers to paper make sense why stocks would fall. And on that note, today it was reported that Blinken postpones his Middle East trip amid uncertainty and also approves a $20 billion Israel weapons package. He was supposed to go there tonight and is canceling this. So last time we seen this, this kind of behavior was before the last attack on Israel from Iran. So just, from that perspective, it could be coming soon, this Iran attack on Israel. Now, We've heard it was coming soon for a while now. There were fresh reports yesterday that within 24 hours this attack could happen. That would put the 24-hour mark here in just the next couple of hours. So whether or not that is actually true and going to happen, we will see. But it is certainly something that could happen anytime now, and I expect it would be short-term negative for markets. Now, as far as my actual expectations for CPI and Tesla, honestly, it could go either way. There's been some talk. Come here. There's been some talk about PPI potentially inversing CPI. So PPI came in low today. CPI could come in a little bit higher tomorrow. There's also a chance that we get a really low CPI number. I'm leaning more towards a really low CPI number than a higher number. That could be good for Tesla as long as it's not too low. If it's higher than last month's 0.06%, like a 0.10%, 0.15%, that would likely be to some degree good news for markets. I wouldn't be surprised to see a futures rally or pre-market rally, and then to see that really just get sold off throughout the day as some of those deeper growth scares start to come out. Overall, Tesla stock closed above the 200-day moving average today. That was great. That was the first step towards a larger rally that we need to see. We did have a golden cross as well back in late July that did materialize, and we got nothing but downside. So perhaps we start to get that catch up upside here, but we do need to break above that 50-day moving average around 211 or so, then to make our way to that 215 level. 215 is one of your first major downtrending resistance lines, so it wouldn't surprise me to find a little bit of resistance around that level into the close of this week, and then to potentially see a larger rally next week. But I really think it's going to come down to retail sales. If retail sales come in good and we actually beat the estimates are 0.3% month over month. Last month you came in at 0%. If we can actually beat those numbers, then I think there's going to be a lot of capital coming into markets as some of those perceived recession odds do fall. So that's kind of my take on this situation. Israel, Iran, as you guys know, that's going to be a short-term kind of freak out catalyst. It's not going to, lead to anything material for markets. And that's just my perspective. Unless there were to be some kind of larger conflict or fears of like a World War III or something, which there will be some of those fears. But if it's just an attack from Iran like last time and they say, our attack's over with, there's not going to be any other further attacks, and Israel doesn't really do anything, markets are going to get over that pretty quick. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you guys want to come trade some of these events with us live in real time. Check out that link down below in the description of this video. You guys have a fantastic rest of your day, and I will see you in the next one.